to this OMFIF webinar on the ECB's next big decision. I'm Danae Kyriakopoulou, Chief Economist and Head of Research at OMFIF, and I'm joined by my colleague Ben Robinson, Senior Economist at OMFIF. We're sitting here a day before the ECB sits down to discuss the future of its quantitative easing program ahead of this monetary policy meeting tomorrow. It's widely expected that the ECB will announce plans to extend the quantitative easing program beyond the current end date of December 2017, but at a slower pace than what it previously has been. What has the quantitative easing been? What has its effect been on the economy? And what are the constraints for the ECB moving forward? Since March 2015, the ECB has conducted its expanded asset purchase program, under which national central banks and the ECB buy a range of eligible bonds from within the euro area. Total purchases are just over 2 trillion, and this has been mostly in public sector bonds as part of this program. As a result, the ECB's balance sheet has expanded rapidly. As you can see in this slide, the balance sheet is now over 4 trillion, with the majority of that being the asset purchasing program, and within that, the public sector purchases. But what has this effect been on the economy, on inflation in particular, which is the ECB's target? What do you think, Ben?
So as you mentioned, the main goal of quantitative easing was to raise inflation and return the euro area economy to growth. And as we can see here, it has been quite successful in that. The inflation rate is about 1.5%, up from 0.4% before the start of QE. The unemployment rate has fallen from 11.5% to 9.1%, which is a big improvement across the euro area as a whole, and GDP growth is up at around 2.1%. However, the pace of the recovery is different between countries in the euro area, and this does create difficulties for evaluating how effective QE has been on the whole. And also, it's not just these figures are not just a reflection of improvements in the European economy and improvement in European fundamentals. There's also been a global economic upswing and a boost for financial markets, which has benefited Europe as well. And the flip side to that is that external shocks could basically reverse some of these gains, not all of them, but there are vulnerabilities to things like an increase in oil prices, or any number of vulnerabilities, including from the Chinese economic slowdown generally. So there are risks, but on the whole, the euro area economy has strengthened. However, within that, there are some indicators that are not performing so strongly. And one of these is labour productivity. This has been fairly low. It's been actually quite a big decline since 2016, where it's started to plateau. And this reflects a number of things, including weak investment. Nominal wage growth has improved. It's around the level of about 2 or 3 years ago. But as inflation starts to rise, real wages are likely to start falling. And this is impacting household consumption, which is a main driver of the European economy. So on the whole, there is a mixed bag. And this is reflected in the ECB staff projections, where most recently they downgraded their inflation forecast for 2018 and 19 relative to the forecast in June. And GDP, although it increases this year, is likely to resume its level that it predicted in June.
So quite a mixed economic background then. Inflation is improving, but it's still below the target. The economy is showing strength. Forward-looking indicators are improving, but at the same time, there are some elements of weaknesses. You mentioned wage growth, productivity, and inflation, of course, not yet where we would want it to be. So as a result, the Governing Council of the ECB is split between doves and hawks in terms of what the next steps of its quantitative easing will be, and different members of the Governing Council interpret those economic data in a different way. But beyond those economic considerations, what are the other factors that will be driving the ECB's decision tomorrow?
I think one of the main considerations is the technical constraints that the ECB QE program faces. Each country buys, particularly the public sector bonds, according to its capital key share, which is worked out from the size of its GDP and population. Now, although countries are supposed to buy in line with the capital key share, many countries actually lack sufficiently large bond markets to make up their purchases. So we see for Cyprus, Estonia, Ireland, Portugal, the bond markets are not big enough to make up the share, which means that they have been under purchasing, deviating from their capital key by quite large amounts. We see several billions, almost 10 billion for Portugal. And in order for the ECB to make up the 60 billion per month target, other countries with larger bond markets have to increase their purchases above their capital key. So the main overpurchases have been France and Germany, as well as Italy and Spain. It's slightly more complicated than it first appears because Greek bonds are ineligible under the PSBP public bond program because of their low credit rating. So Greece's 2.9% capital key share is spread sort of unofficially among the other countries, which means they have an adjusted capital key share, which is also an important point to look at, and that is reflected in the final column there. One of the consequences of this has been that countries, or rather investors in Spain, Italy, and other periphery euro area countries have managed to sell their Spanish or Italian bonds to the central bank and then use the proceeds to invest elsewhere in the euro area, particularly in Germany and the Netherlands. And this has increased the size of Target 2 claims and liabilities. The Target 2 balances reflect cross-border payments and transfers within the euro area, and they really increased since 2015 and the start of the QE program. And this is one of the challenges that the ECB has to deal with, because the longer QE goes on for, the larger these balances are likely to become, and the greater the risk, particularly to the creditors like Germany, of what happens when or if something goes wrong in the debtor countries.
And it's also creating the problem that the ECB might be running into the issue limit for countries like Germany, because one of the rules under which the quantitative easing program is conducted is that the amount of each security that can be bought for any particular country is subject to a limit, and that's 33% that applies to the sovereign bonds in Germany. So it's though not only a matter of demand, there is this attractiveness of German bonds because of their safe haven status, but it's also a matter of supply, and that is where fiscal policy comes in. So Germany runs the largest government surplus in absolute terms in the euro area at around 24 billion. As a share of GDP, it's also one of the highest. Netherlands as well is quite high, Luxembourg. But as a gross debt as a share of GDP has also been coming down. We've seen very prudent fiscal policy from Germany, and that's unlikely to change even now after the elections. It's very much the policy line. So this creates scarcity of German bonds that are available for the ECB and for others to buy.
And I think this is one of the main considerations that certainly Germany has to look at. From the start of the QE program, Germany, as I said, overpurchased bonds because of the large size of its bond market. But then we see since April of this year a massive decrease in their purchases to more or less in line with their minimum capital key share. So that's not their adjusted one to take into account Greek bonds, according to which they've actually been under purchasing. But the main one that matters, the non-adjusted capital key, they have fallen from actually around 1.3 billion per month just before the decline in April to now essentially zero net over purchases. And this really helps us to understand why. If they had continued average increases at the previous pace, they would have followed this dotted blue line, which intersects with the 33% issuer limit at the start early next year, around January, February, maybe March, if additional bond issuance in the start of the year pushes that back. But we can see clearly that German bonds are under pressure. So by dropping to their minimum capital key amount under the 60 billion per month purchases, they're able to extend to around March, April perhaps. But we expect the ECB to, of course, cut their monthly purchases while extending the length of QE. So if they cut to perhaps 40 billion a month, 30 billion or 20 billion, that would extend the date at which the 33% issue limit or issuer limit is reached. But even so, they would run out at a 20 billion bond per month purchase. They would run out towards the middle or end of next year, which does tie the ECB's hands to some extent, and it means that potentially there are other things that the ECB needs to look at in the upcoming monetary policy meeting.
So what are the things that the ECB could look at? We've had various suggestions. The OMFIF commentary that will be appearing tomorrow is asking for a reconsideration of the inflation target. That could be an option. The changing of the issue limit to be able to extend QE more, that will be politically and legally also quite difficult. So what are the other options on the table for the ECB?
Certainly, changing the inflation target is one aspect. Another one is, should Germany actually start to run out of bonds or run into the risk of doing so, it could increase supranational bonds, which make up around 10% of the PSPP universe. However, this is unlikely really to meet the size of the demand from Germany. It has by far the biggest allocation under the PSPP, and most of the demand for these supranational bonds comes from the smaller countries that don't have their own domestic bonds, particularly the ones we see here, Cyprus, Estonia, Ireland. If Germany starts to buy more of these bonds, they will basically run out of substitute bonds to purchase, and that could impact the effectiveness of monetary policy. So this is one option, but it's certainly not the whole option.
Yes, the other option, of course, is to change the issue limit, even though that would have legal constraints, political difficulties. It would also compress German yields and widen the spread with other countries. Many bonds that would be purchased would fall below the ECB deposit rate of minus 0.4%. And as we can see in this slide, since January 2017, bonds below this have been eligible, and this has allowed shorter maturity bonds with negative yields to be purchased in Germany. And so as we see, there is more shorter dated maturities that have been bought. And this is also having an impact in terms of the bonds that are maturing and what the ECB can do with them. So there is a very large group of bonds, particularly in Germany, that will be maturing soon. And the ECB has committed to a reinvestment program, but it hasn't given much detail as to what kind of rules this reinvestment will be guided by. So will it be the same asset classes? Will it have to be bonds with the same maturity? Can the ECB exploit those rules or those lack of rules to be a bit more creative and support its program with the reinvestment that should counteract the tapering to some extent, because it will still maintain its balance sheet to the level that it was before if it continues with its reinvestment program. This is a policy that was followed by the Fed, by the Bank of England as well, so there is definitely a precedent there that the ECB is following. But the other important point is also who will be making those decisions, and all these options on the table, how flexibly the rules will be exploited. Draghi's term runs out quite soon as well, and there has been some speculation in terms of who might take over from him. OMFIF ran a poll of our advisory network comprising of policymakers, academics, private sector practitioners in terms of who is the most likely to take over from Draghi, and Bundesbank President Weidmann's name has been the most popular one, attracting 61% of the vote of our survey. But would that be difficult of having a German president of the ECB? What do you think, Ben?
Obviously, much of this depends on what happens in the euro area economy over the coming months and years. And if things start to deteriorate and the ECB needs to increase purchases or to extend beyond the current end date or the date that is agreed on tomorrow, if they do reach a date, it would be very difficult for a German to preside over that. He would be presumably appointed under the hope that he would bring an end to bond purchases and eventually start to wind down the ECB balance sheet. And if he was unable to do so because of external factors impacting the European economy, that could be problematic. And this does feed into a larger narrative that affects central banks all over the world, because the longer QE goes on, not just in Europe, but the longer the US keeps its balance sheet large and keeps interest rates low, the less room central banks have to deal with the next financial crisis. And the longer it takes interest rates to normalize, basically the less room the ECB will have to deal with this crisis. And we've seen so far that although inflation has started to rise, there has been a limited effect on short-term inflation, and this has been impacted by technology and globalization, which has kept the rate below potentially what it should be, with over $2 trillion worth of purchases, or euros. And then there's the fact that long-term interest rates are depressed by structural factors, including aging populations and high savings rates. So there are limits to what the central bank, in fact, can do. And obviously having a German president of the central bank who is, or appears to be, less powerful in the face of these charges could be quite difficult.
Well, it remains to be seen tomorrow. And thank you all for joining us for this short webinar. The full report of our analysis is available on the OMFIF website alongside other articles on the ECB. We mentioned the one about inflation targeting, rethinking the ECB's rules there. And we hope to see you at another OMFIF webinar soon. Thank you very much.